Welcome to TLC 10 Life Community Podcast, where we dive into the heart of our local community, its wineries, restaurant, business, and some real estate. I'm your host, Troy Anderson, along with my co-host, Pamela, and we're here to bring you a new perspective on what's happening in our community. This week, we have a guest on the show, Alex Burch of Veritas Equity Partners. Welcome to the show, Alex.
Thank you. Good to be here.
Yeah. All right, well, before we dig into our main topic of the day, it's time for Sipping on Success, where we always open something delicious from our region, whether it's Washington or right here in Woodinville. Mm-hmm. It's wine this week, shocking.
Hey.
What do you have for us?
I have a Mark Ryan, The Dissident, Cabernet Sauvignon, and it's a 2022. And it is 85% Cab, 10% Merlot, 3% Cabernet Franc, 1% Malbec, and 1% Petit Verdot.
All right, well, Troy's going to pour us all a glass, and we're going to partake. We're going to taste it. We're going to put our nose in the glass, see what we can smell, what we can taste, and then tell our audience about it. But while you're doing that, Troy, why this wine, or why this wine?
Mark Ryan is a really great tasting room right down in the old Red Hook Brewery area where DeLille Cellars is. There's a few other wineries in there, and their tasting room is absolutely gorgeous.
Okay.
But more than that, their wine is amazing as well. But it's worth a visit to the tasting room because, you know, as we're going into summer here, you get great views of Mount Rainier through the valley there. I just think it's a good reason to be reminded to get on out and visit some local wineries, take a walk. The trail's right there.
Yeah, there's some great views around there, and some great places to eat
and
too.
Enjoy Mark Ryan.
Mm-hmm. Okay.
Yeah.
Do they do food at Mark Ryan? Do we know?
There's food. There is something. Yes,
okay.
I don't know what.
We'll dig into that.
I think it's like apps and stuff.
Yeah.
Yeah. Mark Ryan's great too because you can find it in a lot of the local stores.
For sure.
So
for sure.
that's one of the differentiators too.
Yeah.
For sure.
All right, so everybody has a glass. Well, cheers. Here's to a great
Cheers.
conversation.
Yes.
And wine on a Wednesday. Why not? Right. Okay, so let's see what we think of this wine. So color-wise, I'm going to let you guys kind of have a,
It's
check
nice
out the bouquet. And
it's nice and
take
dark.
a taste. Yep. As Troy says, it's very dark in the glass. There's not much of a brick hue around the edge of it at all. It's got real great clarity of color. I don't see much residual in the bottom of the glass either. Any of that kind of, what's the word I'm looking for? The little bits.
Oh, the sediment?
Yeah, the sediment.
Yeah.
Thank you.
Yep. I didn't see any of that.
There's none of that in there. So that's what I mean when I say clarity of color. I'm not seeing any of that in the glass, which is good. All right, Troy. We should let our guests go first, but Alex.
So I can talk high level. I think it's I think wine is really interesting because there's all this depth that you can get into with tasting notes and all these things. I'm certainly not trained in that, but the first thing I thought of with this is it's just super drinkable. Like it's just really good.
Yeah,
and so
it's smooth.
This would be a good wine for somebody that's maybe newer to red wine to get into it. Just because it's so good.
Right.
But
I feel like it's very approachable, but yet it has depth. It's like still lingering in my mouth
Okay.
after several minutes,
Okay.
which
They would
is
say,
good.
Like the first taste, the second taste is when you really get
Yeah.
to
Right.
kind of pick out what those flavors are. I haven't tried it yet, but I have had my nose in the glass. So, we do have, I've twirled for a little bit, we do have the legs running down the side of the
Yep.
glass, so it does have that really great viscosity to it. From a nose flavor profile, it's really, you don't get that alcohol punch with it, which I appreciate, because sometimes it can be, for me personally, it can be a little bit off-putting. It has,
Especially when you first open the bottle.
exactly, and which we literally have done. We've literally opened it, poured it, so it hasn't had time to breathe. So you don't get that punch, which I think is great because it allows you to really kind of sink into the flavors there rather than focusing on the alcohol of it. So, all right, what are you guys tasting then? What's the flavor profiles you're getting from the wine?
I get a lot of jam,
Okay,
jammy flavor.
jammy.
Yeah, raspberry.
I can see the raspberry.
Yeah.
Yeah, I can see that. It's definitely, yeah.
what does it mean with the legs? What does that mean? You said
Okay,
viscosity, but like, what is that telling us?
It's
Because now I'm just like looking at it. I'm like, I know what viscosity means, but tell me what these legs mean.
motor oil.
Yeah,
No.
yeah.
No, I mean, red wines tend to have a little bit more viscosity, thickness to them.
Right.
It is a little bit more than water, so they tend to have those what's called legs or I don't know what the proper term is for them, but yeah. And so I don't know. I mean, it helps with the mouthfeel. I think it stays on your cheeks a little longer, maybe.
Yeah. I think what's interesting is I was expecting it to feel heavier in the mouth.
Right.
Because of the legs on the side of the glass. And it really isn't. It's
No.
really kind of light and zesty. I see why you're tasting the raspberries in it, because it has a little bit of that sharpness to it, which is nice. You know, it definitely feels like a summer wine.
That's what I was
It
going to say.
does,
This
yeah.
feels like an outside, like hanging outside,
That's
drinking this.
Are you going to say
Yeah.
it?
Good pick. It's
you
not it's you could pound it on the porch. It's not a
Is this-
porch pounder.
That's perfect. It's perfect. That should be in the tasting wheel here. Like, is it a porch pounder or not? I think that's perfect.
No, I don't think Mark Ryan is going to be happy that you called it a porch pounder.
I didn't. I said you could pound it on the porch.
Yes, this is
Not that
true.
we're pounding wine. I mean,
No,
that just
we're not.
sounds bad. You just don't.
Yeah, I think this is actually, it has a really sophisticated palate to it, I think. You know, it has that light airiness to it. It's a little dry, but not
Yeah.
super dry.
Right. It's not a lot of tannins. A lot
Yeah.
of fruit forward, very approachable, like Alex said. Drinkable right now.
Okay, well that's good, because we're going to continue to drink it.
Yeah,
So
for
that's
sure.
always good. All
Perfect.
right. Any final thoughts on the wine?
Could be cougar juice.
No. No. We're not doing that either.
Last point I would make is going back to that, just drinking it easy. It doesn't need food. I think,
Right.
you know, like you
Right.
can just drink it. Like a lot of some reds, at least in particular, like I feel like it needs food.
Yeah,
and
like you
this,
need a good steak or roast beef or something
The super
like that.
tannic wines, yeah, you definitely need like a good hunk of cheese to go with
Yeah.
it, or a nice
yeah,
fat-filled steak.
yeah. This one you could just roll with. So it's
Yeah.
good.
One other flavour note I'm taking in this is apple.
Apple?
Yeah, like a Granny Smith apple.
It's got a little bit of the tartness. The
Yeah.
acidity is a little bit higher than you would expect for Cabernet, and that does make it more drinkable for sure.
Yeah, no, it's great.
Yep.
I'm not disappointed with that in the slightest.
No, it's very good.
Well, good.
All right,
That's
well,
a winner.
we will continue to drink that, and you know, we're going to take a really quick break as we always do,
Yeah.
and then we're going to come back with our conversation with Alex all about Veritas and what they do. It's a hefty topic, but I think it's one that our audience will enjoy, and they're going to learn a few things today. So
We can keep it simple. It's good. Yeah, yeah, yeah.
All
We're
right.
about keeping it simple around here.
Yeah.
We certainly are.
Yeah.
All right, stay tuned.
Welcome back to 10 Life Community Podcast, and we are here with Alex Burch. He's one of the partners at Veritas Equity Partners, and his company represents that it's making waves in the world of real estate investment. Veritas Equity Partners, with over $50 million in assets under management and a lifetime annualized return on investment of 32%. That's great. This equity firm is rooted in truth, transparency, and strategic foresight. Veritas focuses on acquiring and managing workforce housing, multifamily apartment communities that not only offer stable returns for investors, but also support long-term community growth. Let's dive into what makes their approach unique and how they're helping people build wealth with purpose. I like that.
Yeah.
So let's start off. Can you explain what Veritas Equity Partners does in simple terms for someone who's never heard of what private equity is in real estate?
Yeah, definitely. So we put together apartment deals. So we only buy these workforce housing apartment complexes in Washington State
Okay.
in certain markets. We've only ever been here for 15 years. We will only buy here for
Okay.
the next 30. That's just what we do and what we know, so we'll stay there. And we make these deals accessible for people to actually own pieces of apartment buildings
Okay.
inside of our network. So if you want to be a real estate investor and get your money diversified there,
But you don't want to deal with toilets and tenants?
But you don't want to deal with toilets and tenants. You don't want to collect rent, and you don't want to put $500,000 or $1 million into something. You could start with 50 grand or 100 grand or whatever
Okay.
the number is. That is just much more approachable.
Gotcha.
Yeah, yeah,
That's great.
Yeah.
Tenants and toilets, that's what you came up with.
Oh, that's
That's
yep.
what it,
Yeah.
tenants, toilets, and then there's another T too.
Is
Termites.
Termites,
probably.
yeah.
yeah. We don't have much of that here, but
Okay,
yeah,
well,
yeah,
that's
yeah.
So let's get into the foundation of your company. What inspired you to create Veritas Equity Partners? What's your core value, truth, integrity, and transparency
Yeah.
show up?
Yeah, so for about 13 years, I was just personally buying these apartment deals on the
Okay.
side of, I was working in tech like so many people around here.
Gotcha.
And I was just doing this as like a means to build long-term wealth, but it wasn't like my main focus. And then over the years, accumulated a fair portfolio and realized we had a pretty good model. And so 2 years ago or so, put together Veritas Equity Partners to start raising investor money and just rinse and repeating the same thing over and over again.
Okay.
One of the big inspirations for us was just when we were learning who's out there, what they're doing, the other groups, other opportunities that people have for private investments. A lot of them were just, there's no transparency in them. They're totally blind. They have no idea what they're actually investing in. And quite frankly, a lot of the operators weren't super ethical in the way that they were doing it. So my business partner, Lauren, and I put together Veritas with, I mean, the name implies, truth, transparency, all of these things.
Gotcha.
To give people not only access to these awesome deals, but to do it in a way where they know exactly what they're getting into. Our communication is ultra transparent, good or bad, and it's just kind of our ethos from the beginning.
Okay, appreciate that.
Now, is it considered a syndication then? That's what it is?
So we've done syndications.
Okay.
We'll do like joint venture deals with other real estate investors. We're typically going deal by deal. That's not to say we won't create some kind of fund down the line, but for now we just like doing deal by deal.
Okay.
Yeah.
Okay. All right. Well, let's dig into real estate investing a little bit more, because there are many ways for people today to invest in real estate, and most people probably have no idea what half of those things are. So, obviously you've got stocks, you've got crypto, and then you've got REITs. REITs. Okay, there you go. See,
Yep.
I don't know anything. Can you walk us through how your approach differs from REITs, and what makes investing directly in multifamily real estate more appealing to investors? And I think before we kind of dig into that, we should probably explain what REITs are, right?
Yeah, no problem.
You go ahead and tell us what a REIT is, if you wouldn't mind,
Sure.
and then kind of distinguish that between everything else, and then talk about what you guys do.
So 10,000 foot REIT stands for Real Estate Investment Trust. What you're essentially doing is you're buying a share in a fund that operates a bunch of buildings, but you're not actually owning any of the building. So you're owning a piece of like a fund that owns the buildings, but
Okay.
it's not a direct investment in real estate.
So it's like a stock of...
It is exactly.
real estate.
It's a stock, and they're publicly traded. You can go on these things. You can buy $100 worth. You can sell it at any time. That's probably the only advantage to a REIT over any other private real estate investment is liquidity.
Okay.
But even if you look over the last 75 years or 100 years or whatever, you can look at historical averages in the S&P for stock, and you can look at historical averages for REITs, and they march to a super similar drum in terms of like your returns.
Right.
So, I mean, over the last 50 years, I think REITs returns are like 8 to 9% tops, averaging 6 to 7 a year. It's more like a dividend investment, quite
Gotcha.
frankly, but you don't get any of the tax benefits. You're not actually an owner of the real estate itself. You're just ripping cash flow off of these things along the way.
Okay.
Yeah.
So there's no depreciation?
There's no depreciation. There's no.
Who takes that?
The fund managers.
takes
So
that.
REITs,
Yeah.
REITs are cool vehicles. I think they were created to give people the idea that they're diversifying,
Right.
into real estate. But the look and feel of it, and when you look at the mechanism of it, it's basically you may as well buy a stock. The dividends that you get, if you get 6% a year on your investment, it's taxed ordinary income. Like there's no mechanisms that you can utilize like you can in our deals or private deals or investing directly.
Okay.
So there's a ton of reasons to not do that, but there's also challenges in terms of getting in with the right syndications and things too. So it's not all straightforward.
All right. So then, talk us through how your approach differs from that.
Yeah. So REITs hold a bunch of stuff, inside of it, and then the performance of the whole portfolio. I believe it's 90% of their cash flow they must distribute or something out to their investors. But all of the appreciation, all of the tax benefits, all of the depreciation, like all of these things go to the actual owners of the properties, which are the fund managers and fund owners.
Okay.
So the investors are basically just feeding these things and getting the cash flow. And that's one element of our deals as well. I mean, that's how all apartment buildings operate from an investment perspective. That's one of the pillars. But I think it's the least important pillar. I mean, it's important in terms of underwriting and understanding if the deal's good to understand what the cash flow is going to be. But in terms of like why and how you get wealthy in investing in real estate, it's the least important one.
It's appreciation and depreciation.
It's yes. So it's the whole business model. So that's the difference with ours is when people invest with us, they actually are an owner in the entity that owns the building. So you are
a fractional share?
You are an actual owner. Yeah. So I mean, if we raise $2 million on a $5 million apartment deal, and you put 5% of the equity in, you own 5% of it. And so if there's $300,000 in depreciation, you're getting 5% of that $300,000 of depreciation.
Okay.
So all of the benefits are passing through exactly like you bought it yourself.
Right. So you're actually owning a portion of the house as opposed to the paper on the house, if you like.
Right.
Or just the cash flow component or whatever. Yeah.
Okay.
So it's huge in terms of different.
Okay.
Yeah.
All right. Wow.
Yeah. The other cool part about us or private deals versus like REITs or closed funds or any of these things is you get to pick the asset you're investing in. So, us at Veritas, we're doing 6 to 10 deals a year on average. So but you literally get to see the building that you're investing in. You get to know where it is. You get to know why. You get to see our whole business plan. Like, you're getting monthly, quarterly updates. Like, you know exactly what's going on in the thing. So there's super transparency across the board.
Because you're maintaining everything in Washington State, right? Whereas the REITs could be anywhere in the country.
And they could buy anything inside of that thing. And it could be, there's proportional rules around REITs. Like, I think it's 70% of the REIT has to hold like real estate assets, but there could be other things in that other 30%. They could be buying storage units. They could be buying apartment deals. They could be buying commercial office. Like, you really don't know. Okay. So with our deals, it's like you're choosing, I want to invest in this 33 unit in Marysville, Washington, and this is the deal that I'm going to own a piece of. There's an LLC specifically for it, a specific bank account for it, like all the visibility's there, and it's direct.
Oh, okay.
That's cool.
All right.
Yeah.
Wow.
Yeah.
That's really cool. Because I've heard of REITs. When I talk to my husband about these things, he's
Yeah.
like, oh, we've talked about, is it good to invest in these? But it sounds like you've got more of a hands-on kind of feel with where your money, and it feels a bit more tangible than...
Well, it sounds like the returns are better too. We're probably going to dive into that later.
And we can dive into that anytime, but there's buckets in these things, right? So like if you invest in an apartment deal, there's going to be cash flow. Like, that's going to happen. It's usually going to be between 6 and 9% a year on the money that was invested. That's the money that the REITs is giving out, to people that are invested. Then there's the appreciation play. Like, and that's a whole another ball of wax. That's what we focus on. Like, that's how we're able to realize, 30+% returns. And that's not something that we like guarantee anybody. Like, the way we look at deals is if we can see a 15% a year return annualized, we'll buy it.
Yeah.
And if that takes 5 years, maybe it'll be 15 to 20%. If it takes 3 though, then all of a sudden it's 25 to 30. So it's just time value of compounding is really what we're focused on. But investors are benefiting from that too.
Okay.
So that's the big piece. And you're getting all the depreciation along the way, which is huge for taxes.
Right.
So,
Wow.
yeah.
You see, Troy's like eyes are lighting up.
I know, I'm like-
He loves anything to do
Yes.
with investing and
Yes.
how obviously because he's in
I
real
can-
estate. But
I can geek out on depreciation too, dude.
It is such
cost segregation. And
It is amazing.
Yeah.
Like, it is an amazing mechanism. It's completely above board. It's the best. It's the best game in town in terms of, like, I call it like the best money machine in the world, because like you can create money, you create long-term money, you create cash flow. It's all tax advantaged. It's inflation proof because rents move with inflation. So it's like when you look at all these things, it's like I don't think there's a safer thing, really, to be invested in than these types of deals.
Okay. Well,
So-
we'll definitely get into this tax side of it later on in the show, but let's focus a little bit on something that Troy mentioned in when he was talking about what Veritas is, and it's the workforce housing, right? And that fills a critical and often overlooked niche. I know
Huge.
here in Woodinville we talk about that,
affordable housing.
Affordable
is a
housing.
Big buzzword
Huge
in
problem.
all the cities across the Northwest.
Yeah, exactly. So can you walk us through why this asset class is so important and what makes it such a smart and impactful long-term investment?
Yeah.
And for those listeners who really don't follow housing trends, a quick definition of what you guys mean by workforce housing would also kind of be helpful to elaborate.
Yeah, for sure. So this is a big differentiator with us versus a lot of the other groups out there that are putting these deals together, is we only focus on this exact type of asset class and only in certain markets. And we're talking Snohomish County focus, Eastern Washington in certain markets, and we'll dabble in other markets if they make sense, but for now we're just focused right there. So we know these markets like the back of our hand. Like, I was born and raised in Everett, live in Kirkland now. It's like everything's local. Workforce housing to us, it's not affordable, meaning it's not like Section 8 housing. It can be, if that's something that makes sense, but so there's no contractual obligation to do anything in particular, but who our tenants are if you think about it, the workers that are supporting the cities that you live in. So blue collar usually, $60,000 to $100,000 a year incomes, maybe not be able to afford a house, probably going to rent, and we provide them just really good places to live. So we're really targeting those people that, like, the workforces of the regions that are going to be renting, that need that median rent number, in order just to make their finances work. And we're trying to be the best provider of that in the market.
Okay.
That's cool.
So what makes that such a smart, impactful investment for you and for those people that put into?
Yeah. Most of the big funds that are buying, including REITs, including institutions, and there's a couple of big operators in Washington, but they have to place so much money at once, just because they're getting it from venture capital usually, or some form of institutional money. So they have to buy these deals that are like $30-40 million purchase prices just because they have to put out a certain amount of money. And so that's the new fancy ones. That's the new development stuff. Like it's all there. The returns on those are really skinny. Unless the market's booming and everything's going up and debt's really cheap, like then they work, just from appreciation plays. But in terms of just operational appreciation and forcing that appreciation that way, they're really tight. So the returns are low. We're playing in the space that's like $4 million purchase prices up to maybe 10. And we're buying these like 15 unit to, like our biggest building, 62 units.
Okay.
But usually it's going to be like 15 to 50 door apartment buildings. And so there's just not that many, if any, groups focusing on those exclusively. And we just, that's all I bought, in my 20s and 30s. And that's what I kind of cut my teeth on, was just understanding how to manage those and what they need and how to renovate them, and just kind of getting all those systems in place, because we don't have on-site management. So we kind of figured out how to do that. So
I guess that was one of my next questions, kind of a sidebar question, is obviously you buy into it and you have that. How do you maintain those properties so that it's a good living environment for those people that are renting from you? Yeah, first and foremost, we capitalize the deal properly, so we'll have enough cash. Like that's a big miss that we see a lot of kind of early investors or syndicators do, is they don't calculate how much money it's really going to take, to renovate units and to turn units around and to renovate exteriors and do roofs and these kind of things. So, it starts at the inspection, right? But finding these things and ultimately managing them, we have third-party management. We just rolled out our own in-house property management for our assets in Snohomish County.
Okay.
So we're going to be taking that all in-house, and we'll do that slowly across the board as we continue to grow. But really, it's just a combination of very vigorous asset management is kind of the term that we use. So we're in our property managers' offices at least once a week, making sure we're setting the rents, we're managing the unit turns, we're managing the dollars, like all of that. And they have essentially just been collecting checks and quarterbacking vendors.
Right.
But it took a while, like it took me, like I self-managed my own up to like 50 units. And it was really hard, like really hard.
That's a lot of tenants and toilets.
It was really hard, man. And so, I'm talking showing up on the door, knocking on the door, collecting rent checks, going and getting quarters out of the coin-op washer and dryers every couple weeks. I didn't know any different. That's all I knew, so it was fine, but very challenging. You get up to where you have 200 or 300 doors, and all of a sudden you have scale, and then you have the ears of contractors, you have consistent work that needs to be done. So now we just have this vendor network of people that are ready to go. We can just text them and say, hey, roof repair, this address, go, and they'll go, and we get good pricing. And so it feels like we're at this scale point where it's now we get the advantage of all of this, just economies of scale across the board, and that's how we're doing it. Okay. But there aren't many, if any, groups our size focusing on these deals. And that's our thesis, is we want to buy as many of them as we possibly can, just because of that.
Okay.
So I think I kind of heard between the lines there that you potentially buy something that could use some deferred maintenance.
Yep.
And then you renovate possibly, and then put tenants in and stabilize it out.
Yeah.
Okay.
Yeah, so our tenants are generally very happy after we buy the building. So that's been a fun part of this too. It's not just, making money's great and we have to for it to work, right? But at the end of the day, the tenants are super happy that we take it over. And a lot of these things are owned by generational families that have had them for 30 years, and maybe their kids inherited them or something, and they're not really that interested in actually running them, and they're self-managed. We get these books and they're literally scribbles on napkins sometimes in terms of, and I'm like, how in the world is this happening with a $7 million apartment deal?
Yeah.
It's like that. So they're kind of a mess a lot of the time, honestly. But when we come in, we clean everything up. We'll increase the rent a little bit. We're not gouging anybody. Our tenants are super happy. We rarely lose anybody. Our collection rates are super good. Our vacancy rates are really low. But yeah, we're renovating units. We're cleaning them up. We're doing all the deferred maintenance that's needed. We're making sure the exteriors look nice. People are happy when they come home, and people stay. And so we have a lot of migration that happens too. And we buy them we bought a 17 unit in Linwood last summer, and we've renovated 9 or 10 of those units so far, and literally tenants are just transferring from one to the renovated one, and then we'll renovate that one, and then somebody else kitty corners across and just moves to that one. They're just so they're super happy.
They want to stay. They just want the updated unit.
Exactly.
That's great.
Yeah.
That's the proof is in the pudding. People want to stay. That means you're doing a good job.
Yes.
Right?
Yeah. For sure.
Otherwise, they'll be out of there.
Exactly.
Because there are other options for people. So it's super important to make sure that people are happy with where they're living and don't feel as though it's
Yeah.
it's a sideline.
There's options, and then at the same time, there's not that many options. So in terms of like affordable, like a 2-bed, 1-bath, take Linwood for example, that's $2,000 a month or less. Like there's just not that many of them. It's hard to find. And so then you take one that's been renovated and everything's new inside and it's bright and fresh and it's still around that 2,000, 2,100 number. Like they're thrilled.
Right.
So nobody's feeling like, oh, I'm gonna have to move and go find cheaper rent, because there really isn't.
Yeah.
On some level. So yeah, it's nice on everybody's side.
Yeah.
Yeah.
Very
That's
good.
great. That's
Yeah.
great. So we talked about this already, but how private equity differs from a REIT. But how does it differ from someone maybe just wanting to go out and buy an apartment building?
Yeah.
I guess just maybe dive into the different buckets a little more.
Like individual invest, like just going out there and buying your own fourplex
Why
or
wouldn't I
something.
just go buy a fourplex?
Yeah. Well, you get to learn from all of our learnings, and I would say you get
All
to,
your mistakes,
you get to benefit from all of the scars that I have from, like learning this the hard way, right? And I don't know if there's a better way to learn it. And like that's another thing too, like across the board when we see some other groups that do this, and across the country this is consistent. A lot of them are like ex-Wall Street people or something, that they're really good on spreadsheets, but like they've never gone and collected checks off of a front door, and so having that background is super helpful in terms of just kind of understanding the squirrels that exist in these things and like trying to mitigate them from the very beginning, even down to like inspection strategy. It's like, reading moisture contents in walls and things that aren't on standard inspections. It's like we've been burned by those things. So like we just kind of know how to get in front of them. So the other thing is just cash. You talk about buying a fourplex in any of these markets around here, it's probably at least $1 million, and maybe probably more like $1.3 million or something. And they're not going to cash flow. Like the scale's just not there. So you got to come up with $500,000. You got to go get financing if it's 5 or bigger, which is another trick. That's commercial debt is a different animal than
The DSCR
residential.
stuff.
Yeah, and we do agency loans on a lot of our stuff. So we're doing Freddie, Fannie, but you got to have a track record to even get those loans. Like they're government backed, we get a better rate. They want to incentivize affordable housing investments. Like there's all these other mechanisms that like I just became eligible for those like 3 or 4 years ago. Because I had like 10 entered and exited deals or whatever. And so you need a track record for that. So it's just, if you really want to build like a big business yourself and do like what I did, essentially, like go do it, and like learn that way. But if you're just trying to diversify your money and make money in real estate, like even when the deal performs really well and we get a 20% profit share on the thing or whatever, you're still going to make more than if you went out and did it yourself. Like just because we have all the systems in place to do much better than that number.
Okay.
Okay.
Yeah.
All right. Well, let's talk about money a little bit then.
Yeah.
So, you did mention this earlier. You kind of hit on what your ROI was, but it's clear that it's impressive, the returns that you've had over time with a lifetime annualization ROI of around 32%. What are the key factors that allow Veritas to consistently outperform traditional investments like stocks, bonds, and public REITs?
Yeah.
And what strategies or values do you personally credit with delivering these results? It sounds like hard work is one of them, but especially with such, with you guys' focus being on ethics and transparency.
Yeah. Learning all the lessons the hard way, I would probably is like the best answer to that. The next is just having done it for 15 years and now especially ramping up and doing it so much more. We just have so many relationships in town. So deal flow is most people's challenge. Like most apartment complex deals are transacted off market. Once it's listed, it's probably going to get blown out. Like it's probably not going to make sense anymore. Somebody's going to pay too much for it.
Right.
So we just get so many of these off market deals sent to us every single week that pretty much all hit our underwriting, and it's brokers, it's families, it's direct with owners, it's just the community we've built over, since 2010,
Right.
is a huge differentiator in terms of that. So I think buying well, and also having really realistic underwriting, like your forecasting and all of these things. Like sometimes we'll see books from other groups that are like, they're forecasting a refinance at 3% in 4 years. And I'm like, well, like that's probably not going to happen, and if your whole deal is pending and something like
If
that.
all your profit's hinging on that, then you're in trouble.
Exactly.
Yeah.
So, we're just doing everything as if nothing changes from today, and we're also set up for contingencies if it gets worse. We can hold, we get long-term debt. We don't do any of this floating rate stuff that people are really getting burned by right now.
Okay.
So we're really hedged against those things. And again, being capitalized properly, like we raise reserves, we raise the cash to do the renovations. Like just nothing is too skinny, so we can do everything correctly and not be rushed. Yeah.
Sounds like you're definitely building a big community as well of people that want to kind of invest in that, but also are looking out for reputable people that they can present their properties to.
Yeah.
Which I think, I mean, we talk about community a lot, and building those kind of communities is important. And
Huge.
Yeah.
Yeah, it's huge. And also sellers, like, a lot of these are, again, like generational families that have had these things for a really long time, and like they would just want real buyers. You know, like they don't want these things falling out of contract. Like a house might close in 25 days or 30 days. Like these take 90.
Yeah.
You know, so it's like we've got 30 days of due diligence, we've got 60 days to close the thing. Like that's a quarter of the year. You know, so if they list it and they get under contract with somebody and they end up bailing out, massive waste of time. So there's also a huge benefit to that.
Okay.
Yeah.
Yeah, I would say so. I mean, I think people get not stressed by buying property, but it can feel overwhelming. But you add on the fact that you've got an extra 60 days on top of that for this kind of property, I should imagine the stress levels might go a little high.
A lot of things can change in 30 days, 60 days, 90
Huge.
days. And I mean,
Huge.
it just compounds.
It's huge.
Yeah.
And especially too, that is a lot what we've learned along the way too, is that 90 days when the deal's under contract, sometimes the property managers know they're probably going to get replaced, you know, that are currently managing
Oh,
it,
yeah.
or the family's been managing, and they just start twiddling their thumbs, like they stop caring because they know they're going to sell it, and in those 90 days sometimes deals get derailed
Gotcha.
before you even take it over. But you know, your earnest money's in, everything's hard, it's like you've got to go. But we get in the mix like immediately.
Right.
So we start engaging the current property managers day one in that 90-day window. We start trying to hit our target rents before we even take it over. And it's just a machine we've kind of figured out.
Oh, very
Yeah,
good.
that's very
Sounds
cool.
Very, very smooth.
I like the fact that you guys are just adding value to everyone along the way, it seems like. You know, I mean, the seller's getting a fair value. You know, the tenants aren't upended because you're renovating the whole place. And yeah, it just sounds like...
Yeah, because sometimes it can feel, this industry, and I don't mean this disrespectfully, but it can feel when people talk about it a little mercenary, and this definitely doesn't sound that way. It's
Or predatory is
Yeah.
like
Yeah.
another word.
Well, yeah, exactly.
Yeah.
I
Or
would
that
be
big-
polite.
Yes.
The big
I'm not that
bad...
polite. Yeah.
The big bad developer that's making all this money coming in and just...
And not caring about
Taking
people
over
that
all the
actually
stuff.
live there.
Yeah.
It definitely sounds like you guys have a very different view of how it should be done and what should be done for the people that are...
Yeah,
Yeah.
it's a people business, right? I mean, like at the end of the day, it's like if we're not taking care of our people, like who cares about the buildings? Like the people are the whole thesis for the whole thing. So,
Yeah.
you know, COVID was a really good pressure test for this. You know, we had a couple hundred units. You get told, hey, like you can't collect rent. Like if somebody doesn't
Right.
have to pay you and like they don't have to have a reason, you know, like they can just stop. And it was like, what? You know, like that was absurd. And, you know, I think in the news you hear this message that like everybody that owns these apartment deals are these massive corporations or like these huge hedge funds or whatever. And I'm like, it's just me and I guarantee this debt. And like that was pretty scary.
Yeah.
But I just went out to all the tenants and I just talked to them, you know, and we put notices on the doors to educate them on what the actual rules were. And we've always been this way, even before COVID, though. If you're having a hard time or you lose your job or whatever, just tell us, you know, and we'll work out a payment plan with you. Like, if you're communicating, like, we're going to work with you.
Yeah.
Like, if you just disappear and stop talking to us, like, we're going to get you out. You know, like, that's just kind of how it is. But, like, be a good person to us, we'll be a good person to you. It's all good.
Transparency.
Exactly. Like, and sometimes those conversations are tough, and that's okay. Like, people are people, and they appreciate it. So,
Yeah.
but yeah, no, it's
I like
been
it.
good. Yeah.
All right. So this one's very topical, I think, but you know, many investors today are looking for stability in uncertain times. I mean, the last week has been interesting,
Yep.
for sure.
Yep.
So for those who may be nervous about investing outside of traditional stocks, right? Because that's where most people put their money, is in their stocks and their retirement accounts. What would you say to somebody wondering if real estate is too risky or too complicated? And then can you kind of explain how the multi-family asset, especially workforce housing, helps reduce the volatility
Yeah.
for those people that are, you know, kind of hedging during economic uncertainty or downtimes?
Yes. I think that when you actually get into the business model and understand how these deals go, that what we're doing is the most safe and conservative thing you can possibly be in, like compared to the stock market, compared to anything else. And the returns are, even at worst, 5% a year better than the stock market typically. I mean, there's going to be these boom times where the market spits 25% or whatever, you know, like that happens, but then there's years where you lose. It's really hard to have years where you lose in this if you buy correctly. So when we're buying these things, we pencil them at current debt rates, 7-year fixed debt, you know, like we know what the cash flow is going to be. We're marching to that drum the whole time. So if we get to a 6 or 9% cash on cash return for people along the way in terms of distributions, that's not changing regardless of what's happening with the market. Like rent doesn't go down. You know, like that's another thing. You can look at historical, especially Washington, Western Washington in particular. It's rare if rent stays flat. Like usually it's up at least inflation, like that's
Right,
at least
right.
3% a year.
Right.
So I mean that's your hedge. Like rent doesn't do this. Like
Yeah.
it just doesn't. So I've never had a year where rent stayed flat even. You bump it a little bit, people get it. Like that's just the nature of the beast.
Well, everyone's raising prices. Taxes are up.
Yeah.
Electricity, all that. Utilities are up. So
Yeah. So our returns are just, I mean, I don't want to say bulletproof. Nothing is like absolutely perfect, but just something insanely odd would have to happen for like the workforce housing apartment market specifically in a market like Washington State, to have any real big problems.
Well, it certainly sounds like an investor's not putting all of their eggs in one basket either with that. So there are other people. They're not taking on the whole load of that debt, right?
No, they're not on any of it.
Yeah.
Yeah.
So
Yeah,
a kind of
another
side question that just kind of popped in my head there. So when people are investing in this, I'm assuming that new people to this would invest in something new that's coming up. They can't invest in something that you've already
No,
purchased.
so we essentially operate with we're always meeting potential investors, educating people on what we're doing. We never pressure. There's never you need to make this choice now or never. Like in my mind, we want to meet people and just get to know them, and they'll see our deals and see that they're consistent. That's another kind of beautiful thing about us is if you like one of the deals, you probably like all of them. They're all the same.
I
But
just want to make sure that anybody that's already invested, they're not getting kind of what's the word I'm looking for?
diluted. No.
They're not getting
No.
diluted by new people coming
No.
in. It's always forward thinking.
That's kind of why I was really on the fence between doing a fund or doing these syndicated deals like
Yeah.
this. And funds basically operate on this.
they just keep getting diluted.
They get new money, they use that for distributions, they get and then they're hoping that the deals juice eventually, and it is kind of like a Peter and Paul thing, you kind of have to just hedge it out over time. It's just challenging. These are literally we're saying our target for this deal specifically is $2 million in cash to raise for this thing. Here's the CapEx plan. So we'll say 1.4 is for down payment and closing costs. 300 is for CapEx, renovations, roofs, whatever. 250,000 is for reserves. Bang, that's our raise number. And we'll go out and raise it, and once we raise it, we close the deal, and that's closed. That one is done.
That's it.
Yeah, and so the plan over time is to just develop a good...
And what's the exit strategy? I don't think you talked about
Yeah,
that.
so we buy these things and we know so apartments are valued fully on net operating income.
Sure.
So it's not like houses, right? Where there's this swing and it's all emotional. It's what are the rents? What are the expenses? What's the cap rate for the zip code, right? So you can look at these things and forecast them just bluntly with math. And so our exit strategy is once we can do about a 1.75x to 2x on the equity raised, we'll probably sell it. Because then you're just not using the equity in the deal as best as you can.
Gotcha.
I don't really care that much about an annualized 3 or 4% cash on cash return. We want to do a 1031 or something into the next one, which is a whole nother advantage to this. That's what I did. I did 10 of them from 22 to 35 years old. That's how you make another tax benefit of being in these things. Is you can partake in what's called a 1031 exchange. So you can take all your profits, you can defer all the taxes, roll it into another deal. Now your cash on cash return is calced on your new basis in the deal, which is about double. And you're just collecting this depreciated tax advantaged cash flow. So it's an amazing
And you've got a
mechanism.
new start to your depreciation scale, too.
Exactly.
Yeah.
So it's just a beautiful machine, when you do that. But yeah, it's been really fun. So yeah.
That's awesome.
Yeah.
That was your next question about taxes.
Oh, I know. So let's talk about tax efficiency.
Yes,
What
yes.
kinds of unique tax advantages do real estate investments offer? And
Yes.
what our listeners might not be aware of all of them. So.
Yes. So to bring back REITs, none. You don't
Yeah.
get any in REITs. You just get ordinary income as your tax on your distributions. If you buy a deal yourself, just a loan, or if you invest in a deal like ours, the tax situation is the exact same. So you're getting K1s every single year, which is sort of like your self-employed W-2.
Sure.
As a reference. In the first 2 years, it's going to be negative for sure because we're doing remodels, we're doing fixing roofs, we're doing all
So
that
if you're
deferred
making a
maintenance
lot
stuff.
of income, this is a way to defer your tax.
Exactly. So
Gotcha.
there's and also too just on the deal itself. If you got $20,000 in distributions in a year off of one of these deals, your K1 is probably going to say something in the $5,000 to $8,000 range in terms of reported income because you're getting the depreciation on it.
Oh.
So if you build this stack over time, you're at least 50% off in terms of taxes, if not more. And that's without even doing cost seg studies in these things. That's just standard depreciation with CapEx.
Do you guys do the segregation?
We will.
Depreciation?
We will if we're going to hold the deal, but there's a recapture period on it.
Sure.
You know, so
Gotcha.
if you take it, then you've got to hold it for like another 4 years, or you get kind of hammered on the recapture part.
Right.
So
Do you want to tell us what segregation means on that?
Sorry about that. Yeah, we're just talking all these lingos over here. So segregation is you have on like residential real estate, a fourplex, you have 27 and a half years. You can depreciate out the building.
Mm-hmm.
So what cost segregation is you take the carpets out, you take the appliances out, you take the plumbing out, you take the blinds out, all those things, and those are depreciated over a shorter amount of time. So you increases your phantom expense on the building, which lowers your income.
Yep. Yeah. So big
Did I
big
explain that
write-offs.
right?
You did great.
Okay.
Yeah. So you can. So
Should hope so.
yeah, another term like accelerated depreciation is what it is. Yeah.
Okay.
So instead of 27, you're taking it over 5 or whatever you want to do. I mean,
Right.
you can partition that out too. You can say I want to do over 10 or 15 or whatever. Like it just depends. But it just creates big negatives. So if you have a year where there was a bunch of cash flow, like, and you want to hold the thing, it will make sense to do that. But again, you just want to hold it because if you sell it too soon after doing that, then the government says, well, actually, now we're going to count this as income because, like, you took it all, in these last few years, but there's still this that you should have been doing over time. So it kind of negates it. But if we're going to hold something, we'll do it for sure. Yeah.
So you're taking the risk out of people doing the wrong thing by holding it for them, really.
For sure. Yeah. And that's really the only difference in the way that our deals are structured is investors are partners in the deals. Like they own the piece of the entity. We are just the asset managers. So we're the general partners. We don't have to go to investors and say, hey, we're going to replace this window, or fix this roof. Like we don't have to get approvals from everybody. But in terms of ownership structure, the investors are the same level of owner. They're more owners than we are. So we only participate in profit share if the thing makes money. So it really is leveraging just our network, our expertise, our model, and just kind of sinking money in. And it is truly passive. Like that's the other thing is like I don't think there's a world where there's passive real estate investment where you actually own the thing. Like it's not possible. But if you invest in something like this, it is truly passive, which is also really cool.
Gotcha.
Yeah.
So can you share with us an example of maybe one of your past investments where, your project has an impact on people financially and to the community?
Yeah, it's kind of fun because we have like similar stories happen at every deal basically when we take these things over. It was really fun. So Lauren Rogers is my partner in Veritas, and she and I met about 3 years ago through a network connection, and it's been really fun for me because I've been in this game for 12 or 13 years prior to that, but her getting into it and then we go out to buildings that I currently owned, and they're part of our portfolio, so we're managing them and doing all these things. She got to talk to the tenants, of buildings that I had owned for 2 years or 3 years or whatever, and hear these stories of like they volunteered it up. Like we weren't going and trying to get testimonials or anything. They were just like, oh, you're the owners. Like we love this ever since you guys bought this thing. Like they're safer. We also lease to really good people.
Mm-hmm.
Like that's another differentiator. We're really picky in terms of who we rent to. So the community gets really a lot safer. It's quieter. It's families want to come in if the bedroom count makes sense for the building. Sometimes we'll have studios and stuff that doesn't make as much sense. But one deal in particular in Yakima, it was really fun. It was like just a 27-unit apartment building out there, but a huge like play field, a big swimming pool, all this stuff. But we figured out like a year into owning it, no one was actually swimming in the pool. The insurance was actually 40% higher than it needed to be because of the pool. And all that was happening was like neighbor kids were like throwing rocks in the pool. So like we had to just clean it all the time. Like it was one of these things. So I had the idea to fill in the pool and then put this super fancy playground in. And I was a little nervous that like tenants would be upset that the pool was going to get filled in or whatever, but no one barked at us at all. And we ended up with this like amazing like playground basically. And now we just rent to families, and they're super pumped. So like that's an example of like we just made the thing a lot more useful, and it was really good. But I mean, there's lots of stories like that where they're just happy that a landlord is in there taking really good care of them, and even just little things in these, like a lot of them are neglected, like you talked about deferred maintenance. We're not buying really junky things, like it's not like they're completely neglected. We're certainly not dealing with water damage or like mold or anything like that. We won't do that. But when we take these things over, we hear from tenants all the time, like it's wintertime, their baseboard heater broke. We fixed it the same day. They're like, oh my gosh, this would have taken a week and a half, with the prior owner group, and we would have been really cold. And just things like that. I'm like, wow, so we just take a lot of pride in like just the simple things, like doing them really well.
Yeah, so not absentee landlords.
No, like they are our customer ultimately, right? So like we're just trying to serve them, and like and if they're happy, we win. Like they pay rent, they tell us if something's going on, they turn into like advocates for the building, you know. So that's another thing.
That's something that people don't understand is when the tenant doesn't tell you something's broken and it continues to perpetuate in the building and can become a much bigger problem than if they just told you when it actually broke.
Totally. Yeah,
Well,
for
when
sure.
you have a leak and then it
A
leaks
leak
out
or
somebody else's,
yeah.
But it definitely sounds like your tenants are happy and comfortable coming to you if there's something
For sure.
going wrong because they know you're going to fix it.
For sure.
All right.
Yeah.
So, for anybody who's seriously considering investing in multifamily real estate, what are the top 3 to 5 things that they should be evaluating, both in terms of the asset itself and the team they're investing with? So obviously we want them to use you, but
Sure. Yeah,
people
I
are
get it.
going to shop around. But
Totally.
kind of, what are those 3 to 5 takeaways that our listeners can kind of sit down and really think about this?
Yeah. Track record, super important. Like how long have they been doing it? Like have they been through some kind of cycles? Like ask for war stories. Like anybody that's actually been doing it should have some stuff that went sideways or things to talk about, learnings.
If they're still doing it after COVID, there's
Yeah. I would say understand if you're going to invest in like a syndication type thing or a fund, even if it's closed. I would ask the fund manager for their debt strategy just to understand what kind of loans they're getting. Like that is truly the thing that I think is probably the biggest in terms of, because when you're investing in syndications, you're limited. You're not on the debt, so you're not guaranteeing anything. You shouldn't be, at least. Like, and if one of those are, just run if that's happening. But you don't know what the debt situation is unless you ask. And there's a chance they could be not truthful about it or whatever, but they probably will tell you the truth. And if it's floating, if it's variable, if it's fixed for only 2 years, those types of things are big red flags for apartment investing.
Yeah.
That only makes sense for like house flippers and stuff, and that's fine. They just need it for a year, like no problem. But these deals take time, to materialize. And if you're hedging your whole business plan on interest rates changing or going down or even staying the same, quite frankly, you're in trouble. So and I would basically just focus on the sponsor, their thesis. Like if somebody's doing a bunch of different type of stuff, like if I was sitting here saying sometimes we buy these workforce housing deals, sometimes we're converting motels, sometimes we buy downtown Seattle Class A skyrise, sometimes we buy restaurants. It's like
you don't have an identity.
Yeah, you don't actually know what you're doing, on any of those things.
Right.
And because they're all very deep, and you need even down to apartment investing, like student housing should be its own thing.
Right.
So
like they need to have a niche and
Yeah.
they need to stick to that niche. So
Yeah.
that's more about the the investing team. But if they want to dig a little bit deeper into the product that is there,
Yeah.
what are 3 things that they should they can kind of look at for the actual product?
Yeah, you can look at like offering memorandums, like listings, of apartment buildings. Like you can use LoopNet and like these types of things to just get like a visual on it. I think it's really interesting to read the brokers' narratives. Like we're not brokers, like we don't transact. Like that's not our thing. We buy, but you can read the sort of the storyboard on like why this deal is so good, and you can hear like the rents are 30% under market, and like all this opportunity is there that they haven't been able to capitalize on, and like usually it's a bit of smoke, that's getting blown. Like that's just is what it is. But
he's talking about me.
I don't think he's talking about you personally, but you get the idea.
Yeah, so it's something to and apartment deals are all about rents, right? So like that's what they are focusing on, is like how low are the rents and why should they be what they are. And there's so many data sources out there that you can find that out for free. Like Rentometer, well, it's a funny story. I think it's actually called Rentometer is the name of the platform, but I called it Rentometer for like 14 years. Like, but somebody the other day said Rentometer, and I was like, what the, like really? And then I looked at it, I'm like, oh shoot, like I've been saying that wrong forever. But all they do is aggregate rental data across, Zillow, Redfin, Apartments.com, like all these places, and you can drill it down to like 1.5 miles from a particular address. Like what's the average rent for a 2-bed, 1-bath in this exact market? And just kind of verify.
Yeah.
And then you can look and see, like, 90th percent rent in Linwood is $2,600 a month. This broker's saying I can get $3,400 a month for this thing.
Right.
That's probably not going to happen. And they're trying to sell it at a value that's like $3,400 a month. So that's the
pro forma data doesn't pencil.
No, yeah.
Yeah.
So being conservative there, but kind of knowing what's actually going to happen is important. So yeah, just verifying the information. I mean, like now with the internet, you can if you really want to dig, you can find anything, you know, in
Mm-hmm.
terms of what's happened, what it should cost, what things should cost. I mean, you can find out, and most people that are doing these deals like me, like I'll tell anybody like our exact recipe. I doubt most people would go out and actually just copy it, you know, like
Yeah.
that's, I'm not worried about that. So like I love talking about it. Like
Yeah.
it's not hard. It's just kind of a rinse and repeat model, you know?
Yeah.
Yeah.
Wow, that's a lot.
That's cool.
It's exciting too.
Yeah.
It's like, ooh,
That's awesome.
I
No,
learned
thank
some
you.
stuff today.
Yeah. It's
Yeah.
fun. It's been fun.
I'm excited to invest.
Oh, I love it.
I can see like Troy's smile getting bigger and bigger.
That's awesome. No, I love it. And that's also like, we're really passionate about this area, you know, like, and that's another thing that, you know, you want somebody that's geographically focused. Like, it's super important, you know, like to know the market, to have your vendors, to know what's actually going to happen. And
Yeah.
that only happens with reps. You know, you just need reps doing it over and over again. So,
Yeah, I think that's what we appreciate about you guys is that it's that local focus
Yeah.
rather than, you know, spreading yourself thin
Yeah.
and, you know, going out of state. But
Yeah,
it's
and we're
keeping
not
it local.
we're not chasing like a story, right? Like that's what we've seen a lot of people do too. Is like, yeah, like an apartment deal in Marysville or Everett or Linwood or whatever might be $2 to $250,000 a door. You know, like in terms of like if it's a 20 unit, it might be $4.5, $5 million. You know, like that's what it's going to cost. And you could go to other markets like in Texas or Arizona or Florida or like these other places and, you know, get 2 or 3 times more units for the same price. But there's so many problems with that model if you don't know the market, you know, and it's not as scalable. It's way more risk. So just staying super hyper localized is important.
And you're not on the doorstep to check out what's going
No,
on.
I bought stuff in Texas like 8 or 9 years ago, just single family houses, because I was like, oh, seems like it's gonna
Yeah.
pop off, you know, like I'm gonna buy these, and those deals did really well. But I hated being so far away, you know, and it was little things, and it kind of sounds dumb, but it was like I'd get a thing from the property management company that was like, this plumber needs to come from XYZ city to get the part and then do this, and I was like, I don't know where that is, you know, like I don't know how far that is, like I don't know what that even means, you know, and it was just really hard. And I think to do this right, you do kind of have to be like in the weeds on the buildings, you know, and on the day-to-day stuff, and
Right.
and so it's just really tough to do if you don't know the area really well. But yeah.
Well,
Very
speaking
cool.
of the area, we always like to round our show out with maybe some neighborhood gems or hidden gems that you might like to.
Share with
I
the
lost
audience.
I lost all
I
my
think
words there for a
you're
minute.
just thinking about investing. I
I
can
don't
just see
know.
it on his
Yeah.
face. It's
Yeah,
like,
I love it. No, I love it.
Words and things. No.
I love it.
Hidden gems in the area that you'd
yeah.
like to share.
I've got one, and I'm blanking on the name of the actual park, but it's a downtown Woodinville park, and they do these summer concerts in July.
Wilmot Gateway Park.
Yeah, that. Okay, yeah.
it's a bit of a mouthful.
Yeah, I love those though. Like, and just wandering in there, and there's like a beer garden, and you know,
Yeah.
food vendors, and you know, the music's actually usually pretty good. Kids are dancing up front. Like,
Those are
super fun vibe.
Yeah.
are kicking off just around the corner.
I know. You
Yeah.
always get super excited about those too.
I know.
Yeah. And it is a gem. It's not necessarily hidden, but it's one of those things I
Yeah.
think it's undervalued.
Yeah.
I know there was a few years where I didn't go, and I went last year, and I was like, oh, why have I not been coming to this? This
Yes.
is
It's fun to just come people watch too.
You just
It's
wander
free.
in there. Yeah. It's so fun. Like, and that's, you know, it's like Chateau's got cool concerts. It's super fun, you know, like, and we'll do those too, but much more like structured and, you know, like, I don't know, like a routine behind it and stuff. And like these ones, you just wander in there and stay there for 30 minutes or 2 hours or whatever. And like, it's just awesome. So
Yeah,
big fan of that.
Yeah, you
Cool.
can get food, great food there, wine, beer, cider, you know.
Yeah.
People just let their hair down. It's great. You know, I love watching people in front of the bandstand
I
just
know,
like
I know.
letting
The
loose
kids,
for the
the
evening.
kids are great to watch.
Some of the adults too.
Yeah, I know.
Yeah, that's even like little details on it though that I love is when it gets a little bit later, the sun pushes behind it and there's a lot of shade. You know, so like
Yeah.
if it's a hot day, it's still really comfortable. You're not just like getting beat on in the sun.
Yeah.
But yeah, no, that's a good one.
That's
All
really
right.
good. I like that. I can walk that.
Cool. I like that.
So, all right. Well, this has been an absolutely fascinating conversation. I'm sure we could talk for hours and hours, but I'm sure Troy and Alex are going to talk offline. But we're going to take a really quick break, and when we come back, we're going to see if there's a real estate roundup this week. So,
Okay.
stay tuned. We'll be right back. Welcome back to TLC, 10 Life Community Podcast. We've just spent a great 50 minutes talking with Alex Burch with Veritas Equity Partners, all about investing in real estate with low risk is basically what I took away from today's conversation. Real estate roundup, we usually do one, but I don't know if we're going to do something different this week.
No, I think we talked about real estate this whole segment.
I know
so,
we did.
Yeah, I
So
mean,
it's
there's massively different ways to invest in real estate, all the way from buying your first house is a good investment,
Yeah.
and through maybe investing with Alex and Veritas.
Why is
I've
it so
lost
hard
all
for you
my
to-
words.
Why is it so hard for you to say Veritas today?
Veritas.
Anyway.
I'm going to stop talking.
No, this is your segment. This is the real estate roundup. This is the bit that you do, right?
Yeah, so, if you're looking to get started in investing in real estate, then, reach out to me. We have done everything from, single family investing to multifamily investing. So, we've got the experience there and we've got the connections.
Clearly.
Like Veritas.
Mm-hmm. Well done. Shall we give a round of applause?
I love it. That's perfect. Yeah.
So, just reach out to us, and we can connect you with, what your investment strategy is, and help you get and achieve your goals.
Yeah, absolutely. So, Alex, I think, anybody that's even slightly intrigued about this, whether they're ready to kind of, pull a lever on this or not, it sounds, from everything we've kind of talked about today, you're definitely somebody that people should sit down and talk about, whether they end up working with you or not.
Mm-hmm.
I think you're such a great resource for this, both you and Troy. But tell us, where can people get hold of you to kind of start that conversation and see if it's going to be the right connection for both you and for whoever wants to invest in multifamily properties?
Yeah, so veritasequitypartners.com. Maybe we link that off the podcast episode too. And then my phone number's on there, and we're just really personal. So direct, and we're happy to have coffee and just chop it up. Like, it doesn't have to be now or never. It's like we can just meet you. It could take 3 years. Doesn't matter. So, yeah.
I really appreciate that about you, because that's very much the same kind of ethos that we have. It doesn't have to be right now, but at least have the conversation and open that dialogue.
No obligation with us, we just
and it sounds like
here to share.
No obligation with you either.
Usually if something's forced or there's pressure, something's probably wrong. Like, I just kind of live by that. So it's like, you
prices are going up tomorrow.
Yeah, you have to sometimes move quickly, but like, it shouldn't be like this. It should not ever be, like, we need this now or never. Like, that's a big problem. Like,
well, the thing is, it can feel like a stressful situation anyway. So you don't want to add that onto somebody by, like, we have to do this right now.
Yeah.
We're talking a lot of money for some people for these investments. So taking the time to have those conversations and really flesh out what that means for them, for their future, for their investments, whether it's with you guys with the workforce housing, multifamily housing, or with Troy with, single family homes or duplexes or fourplexes. It always best to start with that no obligation conversation. So Troy, where can we get hold of you?
tendhometeam.com. TEND hometeam.com is probably the best place. You can call or text. Our phone number is 206-504-3660.
Okay, and Alex, one more time with you.
veritasequitypartners.com. VERITAS equitypartners.com.
Don't ask me to do that.
Phone number is 425-231-9008.
Perfect. All right. Well, if you enjoyed the show, we hope you would like and subscribe and share it with your friends and anybody that's thinking of investing in real estate. And if you're watching on YouTube, what do they need to do, Troy?
Ding the dinger.
All right. Well, thanks very much for listening. Until next time.
Thanks, everybody.
All right. Bye-bye.